Making the right investment decisions can significantly impact your financial future. This is a truth that bears repeating, especially as we navigate the complex world of investing. The choices we make today can pave the way for financial growth and stability, or they could lead to missed opportunities and potential losses. One such crucial decision lies in the realm of exchange-traded funds, or ETFs. These investment vehicles offer a way to invest in a broad spectrum of assets without having to buy each one individually. They're like a basket of investments, providing diversity and balance to your portfolio. Among the myriad of ETFs available in the market, two have emerged as popular choices for many investors: the Vanguard S&P 500 ETF, known as VOO, and the Vanguard Information Technology ETF, known as VGT. Each of these funds presents its own unique set of benefits and potential risks. VOO tracks the performance of the S&P 500 index, which is composed of 500 of the largest U.S. companies. It's like a snapshot of the American economy, providing broad exposure to various sectors. On the other hand, VGT focuses on the technology sector, offering concentrated exposure to tech stocks. It's a fund that targets the fast-paced, ever-evolving world of technology. Choosing the right ETF is more than just looking at performance. It's about understanding your financial goals, your risk tolerance, and your investment horizon. It's about considering the economic climate, market trends, and future projections. It's about making an informed decision that aligns with your investment strategy. To make this decision easier, we're going to delve deeper into these two ETFs. We'll explore their structure, their performance history, and their potential for future growth. We'll examine their risks and rewards, their management fees, and their suitability for different types of investors. Choosing between VOO and VGT could be one of the most important investment decisions you make. So let's embark on this journey of discovery and equip ourselves with the knowledge to make the best investment decision. After all, our financial future depends on it. So, what exactly is VOO? You may find yourself asking. Well, let's dive in and unpack it together. VOO, or the Vanguard S&P 500 ETF, is an exchange-traded fund that aims to track the performance of the Standard & Poor's 500 index, which is composed of 500 of the largest companies in the United States. Launched in the year 2010, VOO offers a simple, cost-effective way to gain exposure to a wide swath of the U.S. equity market. Historically speaking, VOO has shown strong performance. Since inception, it has provided an average annual return of around 14%. This means, if you had invested $10,000 in VOO at its inception, your investment would have grown to over $30,000 today. VOO's holdings are as diverse as the American economy itself. It includes everything from technology giants like Apple and Microsoft, to healthcare leaders such as Johnson & Johnson, and even consumer staples like Procter & Gamble. This broad diversification helps to mitigate risk, as the performance of any single company has a relatively small impact on the overall fund. When it comes to fees, VOO is among the lowest in the industry, with an expense ratio of just 0.03%. This means that for every $10,000 you invest, you would pay only $3 in annual fees. However, it's not all rosy. While VGO does offer broad exposure, it is also tied to the overall health of the U.S. market. This means that during times of domestic economic downturn, VEO can be expected to take a hit. In terms of pros, VO offers broad market exposure, low fees, and a history of strong performance. On the flip side, it is susceptible to the ups and downs of the U.S. economy, and may not offer as much potential for explosive growth as some more specialized funds. VOO offers a broad market exposure, but does it outdo VGT? Stay tuned to find out. Now let's shift our focus to VGT. Vanguard Information Technology ETF, better known as VGT, is a unique player in the ETF market. Unlike VOO, which features a broad, diversified portfolio, VGT has a laser focus on one sector: technology. This means that VGT's performance is heavily influenced by how tech stocks perform. From Apple to Microsoft, from Visa to Nvidia, VGT holds a basket of tech giants that have reshaped our world. Looking at its past performance, VGT has indeed been a high flyer. Over the past decade, it has outperformed the broader market, thanks in large part to the tech boom. However, past performance is never a guarantee of future results, and it's important to keep that in mind. When it comes to fees, VGT has an expense ratio of about 0.10%, which is relatively low. It's a cost-efficient way to gain exposure to the tech sector without having to buy individual stocks. A key advantage, especially for those who believe in the continued growth of technology. However, the tech focus also brings with it a certain level of risk. As we've seen in the past, tech stocks can be volatile. When the sector is doing well, VGT thrives, but if the tech sector takes a hit, VGT could suffer. It's a double-edged sword. Moreover, VGT's lack of diversification could be a con for some investors. While VOO offers exposure to a wide array of sectors, VGT is all in on tech. This lack of diversification can lead to higher volatility, making VGT potentially riskier than a more diversified fund like VOO. In summary, VGT offers a concentrated exposure to the tech sector with a low expense ratio and a track record of strong performance. But its lack of diversification and potential for higher volatility may not be suitable for all investors. VGT focuses on the tech sector, often a high-growth area. But is it the better choice for your $10K investment? Stick around as we delve deeper into this comparison. Now that we've unpacked both VOO and VGT, it's time to put them head-to-head. When it comes to risk levels, the Vanguard S&P 500 ETF, or VOO, is generally considered a lower-risk investment. It tracks the S&P 500, which means it's invested in 500 of the largest companies in the US. This wide diversification helps mitigate risk. On the other hand, the Vanguard Information Technology ETF, or VGT, focuses solely on the tech sector. While this can lead to higher returns, it also means a higher level of risk, as it's dependent on the performance of one industry. In terms of returns, VGT has historically outperformed VOO. The tech sector has seen incredible growth over the past decade, and VGT has reaped the benefits. However, past performance is not a guarantee of future results. The broader diversification of VOO may offer more stability in times of economic uncertainty. Now let's think about suitability. For conservative investors seeking steady growth and a lower risk profile, VOO with its wide range of investments would be more suitable. It's a great choice for those looking for a long-term investment that mirrors the overall market. On the flip side, VGT might be more appealing to aggressive investors who are willing to accept higher risk for potentially higher returns. If you believe in the continued growth of the tech sector and can handle potential volatility, VGT could be the way to go. Of course, it's also worth considering potential scenarios. If the tech sector experiences a downturn, VGT could underperform compared to VOO. Conversely, if the tech sector continues to thrive, VGT could offer superior returns. Both VOO and VGT have their strengths and weaknesses, but where should you invest your $10,000? Let's reveal our verdict. It's decision time. Where should you put your $10,000, VOO or VGT? After a thorough examination of both ETFs, the verdict is in. Based on the factors we've evaluated, the crown goes to VOO. Now let's delve into why. VOO, or the Vanguard S&P 500 ETF, is a solid choice for those looking for a steady, long-term investment. It's a broad-based index fund, tracking the performance of 500 of the largest US companies. This means it offers a high degree of diversification, a critical component in managing investment risk. Let's not forget, VOO has a lower expense ratio compared to VGT. This means more of your money remains invested, helping to grow your wealth faster over time. Now, this is not to say that VGT, the Vanguard Information Technology ETF, is a poor choice. Far from it. VGT focuses on technology companies, which have shown remarkable growth in the past few years. However, it's also more sector-specific and thus carries a higher degree of risk. Remember, higher potential returns often come with higher risk. And while betting on the technology sector might seem like a no-brainer given the current trends, it's also more susceptible to market volatility. In essence, the choice between VOO and VGT boils down to your risk tolerance and investment horizon. If you're willing to take on more risk for potentially higher returns and you have a longer investment horizon, VGT might be more appealing, but for a more conservative approach with a broad market exposure and lower costs, VOO stands out. So if you are to invest your $10,000 today, VOO would be the more balanced choice. It offers the potential for steady growth while also providing a safety net against the unpredictability of the market. Remember, the right investment decision can significantly impact your financial future. Keep learning, keep investing, and keep growing.